All right, today we are diving deep into the hidden plumbing of global finance. We're going to uncover something truly fascinating: how a tiny little decision made in Tokyo can set off a massive earthquake on Wall Street.
I mean, that sounds completely nuts, right? 0.25% change does that? But this is the central mystery we're going to solve together. Think of it like a financial detective story. We're going to find the motive, we're going to find the weapon, and we're going to see how the crime itself went down.
So every good mystery has to start with a motive. And in this story, the motive is simple: the hunt for profit. But the source of the cash, well, that comes from Japan's really unique economic situation over the last, few decades.
And the difference is, well, it's night and day. See, while most of the world was dealing with normal inflation and growth, Japan was just stuck. They had this long period of stagnation, even deflation. So to fight it, the Bank of Japan did some pretty radical things: zero interest rate policy, or ZIRP, quantitative easing, yield curve control, you name it. And all of that, it basically pushed interest rates down to zero. It effectively turned Japan into this island of free money for any investor who wanted it.
Now, this free money is what opened the door for a strategy called the carry trade. And it's actually a pretty simple idea when you break it down. Just imagine you could get a loan with, say, a 0.1% interest rate, and then you take that money and you go invest it in something that pays you 4%. That difference, that spread, that's your profit. That's the carry. And for decades, the Japanese yen was the absolute perfect currency to borrow for next to nothing.
So, the big question is, where did all this borrowed money, we're talking trillions of yen, actually end up? Well, it flowed into the hottest, most profitable assets all over the world. A huge, huge chunk of it went straight into US megacaps tech stocks. I mean, this money was a major reason why those valuations just kept going up and up for years.
Okay, so we've got our motive. Easy profits from all this free money. But what was the weapon? What was the hidden ingredient here that turned a simple investment strategy into a global time bomb just waiting to go off?
The weapon, in a single word, is leverage. Because, the profit margins on the carry trade weren't massive on their own. Investors used an incredible amount of leverage to juice their returns. We're talking 10-to-1 leverage, sometimes even more.
And of course, leverage is the classic double-edged sword. It feels amazing when things are going your way, right? A little 3% gain suddenly turns into a massive 30% gain. But, and this is a huge but, the reverse is also true. A tiny little loss gets magnified into something absolutely catastrophic, something that can wipe out your entire portfolio.
So here's the thing you absolutely have to understand. This whole thing, this multi-trillion-dollar house of cards, was built on one single, very fragile assumption: that the Japanese yen would either stay stable, or even better for the investors, get weaker against currencies like the US dollar. If that one assumption ever broke, the whole system was at risk.
We found the motive, profit, and we've identified the weapon, leverage. So now, it's time to witness the crime itself. This is the unwinding spiral. This is the exact moment that fragile assumption shatters and pure panic takes over.
And here it is, the trigger. After decades of zero interest, Japan finally sees a tiny flicker of inflation, and they raise their rates by just 0.25%. I mean, nothing, right? Well, at the exact same time, the US economy is looking a little shaky, and the Fed starts hinting that it might cut rates. This tiny little policy shift completely flips the entire logic of the carry trade on its head. The result is immediate, and it is brutal. The yen surges in value. And for every single investor out there who had borrowed tons of yen, their debt just got way, way more expensive to pay back. Instantly, all their profits are gone, wiped out. And now they're staring down the barrel of massive, massive losses. And this is what kicks off the catastrophic chain reaction. First, the brokers start making margin calls. They're demanding more cash, right now, to cover those huge currency losses. So, to get that cash, investors are forced to sell whatever they can, which means selling their best, most liquid assets. And for most of them, that's US tech stocks. This mass selling causes the stock market to tank, which then triggers automated selling programs, making the crash even worse. And then, and this is the craziest part, to close out their positions, everyone has to sell their US dollars to buy back yen, which only makes the yen even stronger, kicking off the entire vicious cycle all over again. And this quote from the source material just hits the nail on the head. This isn't a rational, thought-out process anymore. It's just a brutal, mechanical feedback loop. The selling literally feeds on itself, and it just gets worse and worse with every single turn.
So after all that, what's the verdict in our little financial mystery? What's the big takeaway from all of this? Why does it still matter today?
Here's the key insight. The stock market didn't crash because these fantastic American companies suddenly became worthless overnight. Of course they didn't. It crashed because the hidden plumbing, the pipes of global leverage, suddenly and violently reversed course. It was a liquidity crisis, not a fundamental crisis.
So what does this teach us? Well, first, that financial markets aren't separate little ponds. They're one giant hyper-connected web. Second, that liquidity, the ability to easily buy or sell something, can be a total illusion. It can disappear on a flash, right when everyone needs it the most. And finally, and maybe most importantly, a tiny policy change in one country can have enormous, completely unintended consequences for everybody else.
At the end of the day, a decision like that little quarter-point hike is never just a local issue. It's a tug on a single thread that can start to unravel the entire fabric of global risk, and it shows you just how fragile the whole system can really be.
And that, of course, leaves us with one final, crucial question. The yen carry trade was one of these hidden connections. But in today's world, which is even more complex, even more interconnected, where's the next one hiding? Thanks for joining this explainer.